Hey guys, welcome to the Short Term Show special episode series on Shenandoah, Virginia. A couple things I want to hit you with first before we get into the episodes. One, current purchase prices and current income data can be found on our website at theshorttermshop.com. So make sure you check that out because that can change all the time. Also, if you guys want to hang out with us and just talk about short-term rental stuff, you can do that with us and 60,000 of our closest short-term rental investor friends at our Facebook group. Same title as my book, Short-Term Rental, Long-Term Wealth. Make sure to like and subscribe to this podcast and all of our podcasts if you can, because that really helps us out. You can subscribe to our YouTube channel, The Short Term Shop YouTube, and then also follow us on Instagram at The Short Term Shop. And if you're ready to buy a house with us in any of our 20 markets, you can email us at agents@theshorttermshop.com or really any of the avenues that I just gave you. Now let's get into it.
All right, here we are. Short-term show, special episodes. Shenandoah. Today we're going to talk about financing. It's my favorite topic in the business. It's the most important part of real estate in general. If you don't know how to get loans, don't know the ins and outs, cross your T's and dot your I's, you're never going to make it. It really is, in my opinion, most important. Maybe not the hardest part of the business, but the most important part. So I've always made it a special effort to immerse myself in all things lending. And today we got Alan Taylor from Short Term Shop Shenandoah and an old friend of his. As a matter of fact, they grew up real close to each other and go way back. So Doug Carpenter, great to have you here, man. How are you?
I'm great.
Wonderful. Cool. So you're with, explain briefly, your brokerage and really honestly, just like the different types of brokerages that may be out there and what type yours is.
So there's, so I'm with Barrett Financial Group, and there's lots of models of how to have a brokerage, how to run a mortgage shop, and there's more models of that than cars. And at Barrett, at least the channel of Barrett that I'm in, there's tremendous autonomy and also a lot of leverage. Barrett's one of the largest brokerages in the country. I think we're shooting close to 900 loan officers scattered all around the U.S., most working out of home offices and or with their own branches. And being that large, we have a lot of leverage and access to a lot of lenders if a loan officer will take the time to learn them and see what his tools are. I mean, a brokerage, a mortgage company is only as good as the loan officer that you're working with, and how in tune with the options at his disposal when it comes to getting lending for your clients and getting those loans done. The loan officer and the team that loan officer is working with, because that loan officer is not doing stuff by himself.
Would you say a big brokerage is going to have more products than some smaller kind of local type folks, or why
more products? But at the same time, I want to be honest here. You could have 1,000 products, but only use 5 or 6 of them your whole life as a loan officer. And so it's really just knowing what's needed, what's useful for your niche or for your client type. And so like Alan has brought me a lot of second home buyers, a lot of short-term rental buyers, and with that, he seems to be in a pool of a lot of buyers with a lot of income. So we haven't done much with the DSCR or much with the alternative lending type products, but those products come in very useful for short-term rentals, where buyers, they want to put less money down. They don't want to put big down payments, and that's where it's going to be good to have products that are flexible, products that allow you to qualify without giving up layers and layers of LLCs and tax returns and stuff like that when time is of the essence to close. And I've had some clients, that say they give me all their tax returns and we find the new LLC. So now we're fishing for more information, and then that opens up another layer of the onion and another layer of the onion. And 2 weeks of digging through layers of the onion, before we have a complete package, and now everybody's stressed out and under the gun to close on time. And that's where something like a DSCR product comes in very useful for somebody buying short-term rentals. And rates on DSCR, which by the way stands for debt service coverage ratio, rates for those are not as high as people expect them to be. I'm in the mid sevens with DSCR, which is right where your Fannie Freddie investment property rates are. And that's on a brokered product. And we lose a little bit of autonomy, but as long as everybody's on the same page as far as expectations, then everything flows smoothly.
Yes. So if I can get a conventional loan, would I rather do that than a DSCR?
It comes down to your market, right? So a conventional loan is going to let you buy that investment property with 15% down. So a little bit less down payment. If your seller's going to give up some a seller concession towards your closing costs, I think on a conventional investment property, the max is 2% of the sell price. But if seller's going to give that up to help you get your financing, and you can do 15% down, you're going to get a little bit better financing that's 15% specifically when we're talking 15% down. So, a buyer could get into a property with a little bit less cash out of pocket with conventional if they can qualify. So I'm always going to look to see if that's an option, to see if that's a viable option for a buyer. And in the pre-qualification process is where we're going to peel away that onion and try to get to the root of that before we get into trying to close on a property. So really just, and that's where Alan's going to be very useful as far as coaching their buyer to let them know, hey, you own all these different entities and businesses. We need the whole enchilada when Doug starts asking for, all the ingredients to your financial picture.
Yes.
And so they're prepared, to produce that. So in that case, conventional is better to get for full doc. But if they're not in a position to qualify full doc to buy that property, then I'm going to take them to my DSCR product with 20% down and rates in the mid sevens.
What's going to put me in a position to not qualify for conventional?
They own too many properties that are too tight to cash flow.
Bought them too recently.
What's that?
They bought them too recently, maybe?
Not necessarily recently, because we can still offset if they have the appraisals from when they bought them. The appraisals are going to have the market rent analysis, for that property, and we can offset the mortgage payment of that property with the market rent analysis. But conventional does limit us to just 75% of that market rent to offset the payment. So take that difference as a loss against their income, plus whatever else they have going on in their life. And once you start buying up lots of properties, it's going to be hard to qualify to go full doc.
Right. Yep. Okay. So the benefit of DSCR is I can do a lower down payment I can, in other words, let me reverse that. Conventional, I can do a lower down payment, but I still get 30-year fixed, but I got to basically put a cattle prod up my backside to get all this paperwork and all these documents.
Right.
But the cool thing about DSCR is less paperwork, less BS. And if I'm a complicated buyer, complicated person trying to borrow a borrower, the DSCR is going to be, a little bit, for lack of a better way to put it, easier. If
a lot easier.
Yeah.
Yeah.
Downside is I'm going to have to pay probably a little bit more interest, maybe. And again, he did mention a rate, and I should mention we were recording this in August 23. So depending on when you're listening to this, who knows what the rate's going to be.
Yeah.
And right now,
get excited and forget about stuff like that.
Yeah, no, that's fine. That's fine. But it sounds like, Doug, you're pretty on par with your DSCRs and your conventionals right now. Is that safe to say, or just slightly higher?
Yeah, pretty much on par. And I'm lean on that DSCR product, but it's such an easy loan to get done so let's dig into DSCR just a little bit, what that really means. So DSCR, that stands for debt service coverage ratio. Basically what we're looking at is now that product with the better pricing, we're using the long-term rent capacity of the property to qualify the buyer to buy it. And so if a property rents long-term at $2,500 a month and the mortgage payment, or not the mortgage payment, but the complete house payment, mortgage, taxes, insurance, and HOA, if there is one, if that totals up to $2,500, then that product is good to go at 20% down. If it's not good to go, then the buyer is going to have to come in with more down payment to get the mortgage payment down to equal the rent.
Right. Yep.
If we have to use the short-term rental income of the property to qualify, which we can do, then it gets a little bit more expensive. probably about 0.5%, 0.75% more expensive in interest rate to go with that product, but it's still within a margin to where most investors are happy, especially with short-term rentals, because you just make more money with them if you're being advised properly, to where that's a non-issue, because now it's more of a cash flow purchase, not so much I'm not sure what the right word is, but they're just looking at, is this going to cash flow? That's
Right.
how an investor is looking at it. So if the mortgage payment is a little bit higher, it's not a big deal for most short-term rental buyers. It's really, am I going to be able to cash flow this? Does it make sense with the amount of down payment I got to put down? And we're still looking at 20% down.
Okay.
As a minimum down payment for that.
Going to go off on a bit of a tangent here and give a little speech, which is the roots of DSCR, which comes from commercial lending in general, which is what I do at this point in my career. I can't even begin to dream of doing a Fannie. I've been out of Fannie Freddies for years, So just to give the listener a little bit of, just to touch on commercial loans a little bit, and generally with a real deal commercial loan, you're going to a local bank that, is basically, for lack of a better way to put it, they're loaning you the money out of their clients' savings accounts, and they want you to be a qualified individual with a track record in the industry and that kind of thing. And it is way easier paperwork wise. You're going to need a relationship. This local bank relationship with a local usually means you've got cash in their bank. And a lot of times they'll even basically set you up with a certain amount of money ahead of time and say, "Here, you're qualified for this much money. Go buy as many houses as you want." Basically, Now you got to be kind of a little bit of a baller, for lack of a better way to put it, to get in a decent relationship with a local bank. You can do one loan here and there with a local bank. I've got a buddy that's always done commercial loans from day one with local banks, and he built with the bank, and they were happy to do that with him. And he's still with the same bank today. And he's got 20, 30 properties. And I did the other way around, where I cycled through all my Fannie Freddies first and then started shopping with the local banks. But again, that's where that term came from, DSCR. In commercial lending, they do everything the same way as what Doug explained, pretty honest. So, but in commercial lending, they want 1.25 on debt service coverage, which means it needs to rent for more than what these we'll consider a new DSCR loan. It's a 1-to-1 ratio, right?
Yeah.
1-to-1 ratio.
And if you've got more down payment, we start going into 25 or 30% down, and you're a highly qualified buyer, they'll go to a 0.7 ratio.
Oh, really? Wow. Okay. That's very interesting.
Yeah.
So a local bank,
you know what you're doing in that scenario.
Well, you're going to want to know what you're doing. That's
plan.
way lean. That is too much for me. I don't want to be that leveraged, first of all.
No, maybe in that scenario, the buyer, I was going to say, maybe in that scenario, the buyer is looking at a property and they can't prove the income that it'll make. And so 0.7, 0.75, the bank's willing to do that loan, but the buyer has a vision and confidence that they'll be able to flip that property into a rental, into an income producer where the ratio gets better. So that's the only thing that makes sense to me in that scenario.
So to pivot back to the local banks, just to wrap up that conversation, which is not what Doug does, but just to cover the whole gamut here, local banks are more conservative. They want a handshake and a bunch of cash in their bank account and all that kind of stuff. And that's totally fine. You get to a certain point, baller. You get to a certain point in your career, you're going to end up with commercial banks 100%. But just be advised and there's no reason to not start with them, but it's definitely going to be more lean on the cash flow every month. So if cash flow every month is your goal, you're probably going to want to do your conventionals and your DSCRs first. And then eventually you get enough properties, you to the point where you don't really, each single property, you don't have to milk it for everything it's worth, and then you can move on to a local bank. And local banks are usually also going to do a 20-year AM, maybe 25 AM. So it's been amortized over the period of 20 years, even though it's a 5-year loan in most cases. So like a 520 is what you're going to get from a local bank, maybe 25. Sometimes they'll do 7 years fixed for 20, 25, but you got to be a real baller to get 7-year. And except in today's climate where their interest rates are high and they'd love to lock you in for seven years, that kind of thing. But so just be advised that you can just go to a regular old local bank. Usually what I'm talking about here is going to be like a First Bank of Shenandoah.
Mhm.
Credit unions are going to take it. Credit unions going to take it to a whole nother level of conservative. I mean, they're like really conservative. A lot of times they won't even lend on investment properties, like primary only. But just be advised that those products are out there. The local banks love real estate. You know, it's the most stable asset class in the world. And if they're going to lend money on something that they can get a return on, because that's what banks are in the business of making money on interest. And if they can lend on real estate to them, in most cases, real estate is the simplest and most reliable thing for them to loan their money on. You know, it's not a widget. It's not opening a new brewery where you never know if it's even going to make any money. At the end of the day, even if you don't make money or you completely fail in real estate, you generally still have a structure that's worth, hopefully, at least what you paid for it. So it's fairly, you know, it's a kind of a warm and fuzzy type of a deal there for the local banks. But anyway, let's move back on let's keep going on the tangent here with creative financing. It's all the buzz these days. And I guess I get to take you guys' opinion on this. Of course, Pace Morby's the huge guy in the space, and he's really launched it into the stratosphere. It's never been anything I've been interested in at all. Like sub 2 is huge now, and owner financing is actually, weird thing is this owner financing is like kind of coming back around because the way the interest is. And there was a period of time there for 10 years, 10 years, no way in hell anybody was going to owner finance you something. And you didn't even really need them to, because you can go get your own damn loan for 3%. Right. You know, so
it was so easy to get. Yeah, you could fog them here and get a loan.
So let's talk briefly, guys, if you don't mind, kind of mashing around here on creative financing. Alan, have you done any creative financing? Doug, either of you guys have any experience here?
I mean, what's our definition on it? Like, what defines, what makes a creative financing situation?
Well, I mean, it's I think it's in the influencer world. It's going to be subject to. It's going to be owner finance. Those are the two big ones that at least that I'm aware of.
Okay. So actually, I'm working on a project right now here in Arizona where an investor, now they're doing it for a friend. So that's one, I guess that's one qualifier. But a friend that they trust too, right? It's not going to turn into a nightmare. But an investor is buying a home with 20% down. They're using DSCR financing to buy it, and in today's market, that their rates coming in in the mid 7s for that. The buddy of theirs is going to then buy the house from them. The seller's going to do a wrap and seller finance with 5% down, and carry that at 8.5%, run that through a local title company servicer, and hope they don't have to foreclose on their friend at some point in the future.
Okay, all right, hold on.
That's one scenario where seller financing.
Hold on, explain that one more time. One more time
right.
On that. Give me in two sentences.
So I'm sorry I don't have the numbers in front of me.
That's all right.
Put up on my screen, but so the investor is buying a home with 20% down. It's a single family home with 20% down.
Okay.
They're coming in at about I guess I'll give you the rate they're getting. They're coming in at 7.75 on their interest rate.
All right.
On a 30-year fixed.
Got it.
They're then selling the house via seller financing to their good friend that they have faith in at 5% down, at 8.5%.
Now wait a minute, this isn't legal. The servicer of the loan is not going to let, you know what I mean? Like, doesn't the seller?
Right, they're not going to let title transfer. So basically, they open escrow with the title company, and it just stays open indefinitely until the home buyer refinances or pays them off.
The third party.
Yeah.
The 5% person.
Yeah.
Yeah, I've actually never heard of this. Does this have a name? You give it a name and put it on Instagram, you make $1 billion.
Name? Well, I mean,
it seems sketchy. What happens if the servicer of the loan, whoever's holding this note, it finds out about this? Aren't they going to be a little upset about that?
It's contract for deed is the legal way that we're doing it. So it's not a true transfer of title, but it's a contract for deed. So it works for taxes for both parties. But yeah, no, we haven't had an issue with it yet. The servicer, I don't know, maybe I'm setting myself up for a phone call from the servicer when they see this. But the as far as the servicer is concerned, the investor owns the property. The buddy they're selling the house to, that's buying it, they're not taking title. They have a contract for deed at an interest rate with payments that's being serviced through a local title company servicer. So there's a margin there. So it's
Now, wait a minute.
like a lease option, but with more bite.
Doug, couldn't they have just partnered on this deal and bought the property in the partnership backed by the higher dollar partners of, financial standing?
Well, we probably should have called you for advice, or they probably could have called you for advice on how to do this.
Yeah, I don't recommend doing this way, but hey, man, it's nuts. I've never heard of it, so it's cool. I'm gonna look into it. Alan, are you seeing anybody doing anything in your market, or is it typical? I mean, I'm not a big.
I reached out to a rep and asked him, "Hey, can my home buyer do this down the road?" And he says, "I don't see why not." So
okay, well, listen, cross your T's, baby. That's all that matters. Alan, what are you seeing in Shenandoah?
Here in Shenandoah, we're not seeing a lot of that. Most of the agents around here, if you ask them about creative financing or wraparound or subject to, they're going to say like, what was that again? I don't know. And you got to be conscious. Like if you're looking to buy a short-term rental here in Shenandoah, if you want to do subject to or creative finance or something like that, you got to realize you're going to have to put in you may have to count on putting in the effort to educate not only your agent, but the other agent and your maybe even like the lender you're working with. So it's gonna be a lot of work. And count on writing a lot of offers and getting a lot of them turned down, because the people out here, they're used to conventional mortgages, 30-day close, all that kind of stuff. That's their bread and butter. And you throw up something in front of them that they don't recognize, it's a little different. They're not going to be sure how to present that to their client sometimes. So it's going to be a lot of upfront work to try and educate them, to know, to get them to feel comfortable with it, first of all, and then, to be able to present that to their client. But here it's such a low inventory market, and people are, anything that looks weird that they don't recognize, they're just going to walk away from. So it's going to be, I'm not going to say it's impossible. I'm just saying it's not typical in this market at the moment. And you're going to find a lot of people just kind of raising an eyebrow, trying to figure out what's going on. So if you can pull it off, hey, we're happy to help you succeed any way you can. But just realize you may have to write a lot of offers before you get one like that accepted here.
Yeah, I think in most cases you're almost weeding yourself out of creative financing by doing short term, because in one of our markets, in a short term shop market, which is a vacation town real estate is high dollar. There's no way around that. I mean, these towns are not cheap. If you're talking about a real vacation town where nobody lives, like Shenandoah, like where I live in Destin, where and the Smokies, and what the Smokies have become in the last 5 years.
right.
Vail, Breckenridge. These places are expensive. And the last two are like way up there, like Maui. But in most cases, you can't even begin to kind of even touch a house that is this high dollar unless you're qualified, So I think in a lot of ways, if you're deciding to get into this asset class, at least the way we do it in the vacation, now you can go Airbnb $100,000 house in Toledo all day long, no problem, and do some creative stuff there on $100,000. That's not as big a deal. When you're talking about a $700,000 house, that if you're trying to get creative, it's almost like, dude, maybe we need to step it down two or three notches. Let's get back into the Toledo thing here. It's kind of something you need to work your way into. So I think there's something to be said there. But the partnership thing, that's something I totally, you could do that, especially if you're doing this with a rich relative. Rich is not the right word, but a wealthy relative. You got a hankering, as we would say down here in the South, to get into a nice vacation property and put it on Verbo. Maybe you got an uncle that's got some dough and he's sick of the stock market or whatever. Partner with him, So partnering, I think, is, if you're going to do short-term shop style rental real estate with these, for most purposes, they're pretty high dollar houses here. I think partnership is probably about your only option as far as creative financing. But back to Doug here. Let's talk to me about refinancing. Do you do any HELOCs, loans, anything like that? But just give me a rundown of after I already own it, what are my options?
Yeah, so we are doing a lot of HELOCs right now, and I apologize before. I'm going to try to keep my scope more towards our short-term rental market and our target audience.
No, that's not at all. It's all man. It's all rental real estate.
And that creative financing thing that I mentioned, that's never going to happen in Alan's market.
Right.
And that's only happening in my market because we have a buddy situation.
Right.
Otherwise, that's not happening.
And what's the purchase price on that thing?
It's 470, 470-ish. But that's a cheap house where I'm at.
Oh, I got you.
That's the bottom barrel. That's, you have to really look to find a house at that price.
I got you. Okay, cool.
And so your single family homes, the homes that Alan's been sending me in from his market, double the price, or 2.5 times that where I'm at is what we're looking at home values here. But oh my gosh, I got all sidetracked. My Ritalin.
Oh no, refinances.
What was your
refinances? Which
refinances
right now, nobody's going to refinance right now, are they? I mean, why would you refinance from 3% to 7%?
Yeah, exactly. I mean, so we're doing a lot of HELOCs in second position, but we are doing. I do have a handful of cash out refis, like full on cash out refis for folks' properties. For 2 reasons. Either they just, weren't smart with their money or stuff happened and now they've got a lot of different debt they need to pay off. And that big cash out debt consolidation refi just puts them in a better cash flow situation. But I've got somebody right now that's, her Airbnb, she owes 150 on it. It's worth 700. And her mortgage on that, her first mortgage on that is worth, is at 4.25%. So it's not the best interest rate historically over the last few years, but she's going to cash out refi that whole thing because that'll get her the most cash on an investment property. And then she's going to leverage that to buy 2 more short-term rentals here in the Scottsdale area.
Right. Maybe so if you want to, and by the way, the short-term shop is in Scottsdale. So this would be a good opportunity for me to say that if you want to buy a house in Scottsdale, just contact us, theshorttermshop.com. But yeah, that's a great move, man. So she probably bought that thing a while back and it's appreciated and she's probably fixed it up. And that's the beauty.
Yeah. It's her trailing home from her last upgrade. And so she moved out of it, bought another house, fixed it up, put lipstick on it, filled it up with all the furnishings that a short-term rental needs. She did her research, her homework, and she's self-managing. And she understands though that she's going to need to bring in a management partner when she adds a couple more properties, because she has gotten those phone calls from customers at 2 a.m. that have had a bit too much to drink that can't figure out the code to get in the front door.
Well, if she came to the short-term shop, she wouldn't have to worry about that.
Exactly.
Teach her how.
That's what I'm saying. I'm pitching the importance of having a good manager.
Send her my way. Send her my way.
But
okay, cool. All right. Well, what else do we need to know on lending?
So HELOCs. You have your convenience store HELOC, what I like to call it. Like you want that HELOC fast in 5 to 7 days. We can do that. We can go up to 70% of the value of your investment property. But I call it the convenience store HELOC because that interest rate is going to be it's going to be based off of the prime rate plus a margin, they call it. And the margin on an investment property HELOC, especially one that gets done quickly, my convenience store product, you're looking at an interest rate today. It's going to be around 13 and a half. So it's not a real pretty interest rate. But again, on a HELOC, you're only paying interest on that HELOC when you're using that HELOC. And so it's intended to be your quote credit card for real estate. So if you have a project that you need to move on quickly, if you have the capacity within your home equity line of credit to move on it, that's where that tool is going to be useful. Not as it's cheaper than a partner and not as expensive as depleting all your cash reserves. So it really depends on each individual scenario.
I don't think we're in an environment right now where you want to take a HELOC on a property and use that as a down payment on another property. There was a period of time in rental real estate history where that was like pretty common. I think we're probably beyond that now, especially with Doug just said 13%. That's a lot of interest to pay back on a down payment. But so be careful, guys. Don't get too leveraged. Here's one more thing. Put your overall leverage as a cell on your spreadsheet. Here's a good story. It's actually where I met Jan Johnson, Alan, who's one of the greatest real estate agents. She's amazing. I knew her before. I knew her, we've chatted online and things, but I never met her in real life. I went to it was a RIA meeting. And this guy was like, basically, you know, Avery and I gave a little speech, and this guy kind of pulled me aside. He's like, "How leveraged are you?" And I was like, I'll be honest, I don't know." So I put it on a spreadsheet. And then I worked on that number. And now my number is very, very conservative and very well done. I feel like I'm right where I want to be. But until that guy brought it up to me, it was never anything that ever even crossed my mind. I was just going out and getting my next loan and getting my next loan and getting my next loan.
Acquisition after acquisition, leverage be damned.
You get into that mode. It's like a snowball, you know, he's like tunnel vision. And then eventually I was like, wait a minute. I was kind of offended that he asked me that. I was like, what are you trying to say? And then I was like, wait a minute, you know, I should probably know what that is. So put that on a spreadsheet. You know, I don't have a number to give you that you should feel comfortable with. That's up to you, but it is good to know that. All right, Alan, what are you seeing on a day-to-day basis? Just meat and potatoes, conventional loans and DSCRs, I would assume. But what are we closing there in Shenandoah?
Yeah, here in the Shenandoah, it's mostly second home loans, DSCRs. Those are the most common for people to pick stuff up around here. I would say anything outside of that's going to be fairly corner case. Again, I haven't run across anybody that's run out of Fannie Mae loans, has to do commercial loans yet. So we'll see if we get there. But right now it's more typically just conventional loans, second home loans, DSCR loans, that kind of thing.
Yeah, meat and potatoes. All right, wonderful. Well, listen, Doug, you're fantastic, man. It's super nice to meet you. I'd love to talk to you again. I have my own another podcast of my own. Love to have you on there someday. Yeah. But on behalf of the Short Term Shop and the Shenandoah Market, Short Term Shop, Short Term Show special episodes, I'm Cashflow Carl, and thanks for your time.
You bet.